Hello, we are Group 10. I'm Chen Bokai.
I'm Tao Zipeng.
And now we are going to talk about the case Amazon in the year 2000.
Okay, let's get started. Okay, just give you guys a quick look through. We are gonna start with introducing Amazon's background and strategy. And in the year 2000, what is the analyst's assessment toward Amazon and what drives the analyst to make this assessment? In the end of this part, we'll show how market react to this analyst report. After this part, we're going to address the 3 questions from the case. We will tell you our assessment on long-term viability of Amazon's business model, our point of view towards analyst report on Amazon's credit risks, and the factors what we think are behind immediate and strong market reaction. Amazon was founded by Jeff Bezos in 1994, and they originally started selling books online. But what kind of thoughts drove them to think that selling books online was going to make profit? First, on the concept of selling something online, they thought they can cut down on stocking cost. Unlike physical stores have to stock lots of inventory to meet the customer's need. And if they run out of stock, they are going to bear the risk of losing their customers right away. An online store can provide invisible but larger capacity to meet customers' need. But why choose book as their product? Because they think publishing industries were fragmented and there was no one dominating leader of the world. And while now the market was the whole world, if they were gonna start with online retailing, then why not? So this is roughly the background of Amazon. And now we will go on to talk about the evolution of Amazon's operating strategy. And as you can see, they chose to set up distribution centers, broaden their product lines, and they also built Amazon Commerce Network and took part in associate programs with other companies. And now let me break it down for you guys that Amazon Commerce Network was built by investing in other e-commerce corporations so that it formed a network, and Amazon at the same time bear the risk of the corporation's operating result. As for associate program, basically this program is that Amazon's website will appear on other corporations' website. And if subsequent sales are made by this way for Amazon has to pay the referral fees from 5 to 15% of the sales amount. Okay, why did they make these strategies? In order to provide timely service to customers and wanted to meet all demands and want to generate more revenue and increase the exposure of Amazon.com. Okay, let's move on to talk about the condition of their financing activity. They had convertible bonds and notes outstanding, and the bonds were rated CCC, which was not a good sign. And they also had cash outflow at least $106 million from the year 2001, and this cash outflow would last for the next 10 years. So there probably exists huge financial pressure. And if they didn't manage their cash flow very well, they were going to have a big headache. Let's move on to the analyst's assessment and market reaction. And here's the report. Since Amazon had gone through years with negative cash flow, and their inventory ratio kind of slowed down, and they had high debt to capital ratio, so the analysts concluded that there was high credit risk, because all the numbers on the financial statement show that Amazon had low financial flexibility. And after the report was released, the market reaction was significant. The price of the 2 convertible debt securities dropped 15% just after the day the report was issued. And the common stock dropped 19% of its price, almost equals to 2.8 billion of its market value evaporated. So, what are the factors behind this downslope on Amazon's securities performance? And we will tell you later on the final part of the presentation. Okay, now the first part is over. We are going to talk about the questions of the case. Let's start with our assessment on Amazon's business model. Before we evaluate the viability of the model, let's take a look at their model first. Amazon's business model comprises of 4 strategies: enlarge product line as possible, and made equity investments in e-commerce startups, made aggressive price strategy, and they also took part in the associate program. And now we will illustrate each of the strategies' pros and cons right now. Okay, we combine these 2 strategies together. And what advantage would these strategies bring for the company? They can acquire wider customer base and incorporate greater revenue from different products. And they can also provide an image that their zero demand won't be met. And since the product line was broadened, overlapped or related products definitely exist. So through the associate program like I just mentioned earlier, Amazon can increase exposure and generate more revenues. But what weaknesses might bring from these strategies? Vague brand identity, hard to keep loyal customers, and the referral fees will erode the profit. Those are the weaknesses these strategies will bring. Next, equity investment. Though Amazon probably can rule out the competition and get advertising revenue, but at the same time, Amazon should bear the risk of investment loss. And then their third strategy, pricing. This strategy might attract customers who have preference in lower price, while it will put themselves on spot if the world business is not good, since this strategy will lead to low profit margin. That means if the total revenue doesn't look good, so does their profit. And now, we finally have to evaluate the long-term viability of the business model. Okay, let's take a look at this sheet. It's the equity investment effect on the profit. And you can see that the skyrocketing amortization expenses from 1998 to 2000. Because Amazon chose the amortization period for only 2 to 4 years, and it ended up creating a bad effect on its profit. You can just look at the figure. The economic effect on profit was getting worse, so we concluded that this strategy will not work well on a long-term basis financially. And now let us take a look on how associate program performed. You can see in 1999, the expenses rising from this program exceeded the gross profit. So this program obviously erodes the profit, and we therefore think that this program won't work out in the long run. And it's because Amazon broadened their product lines. So they decided to build the associate program, and each of the decisions led to some not so good outcomes, which were incremental expenses and investment loss. So wrap things up for the first question, the viability of this business model. We conclude that this business model is not viable, just judging from their pricing policy, which leads to the low profit margin scenario. In addition, those strategies Amazon took on apparently are not beneficial to generating the operating income. On a long-term basis, we infer that the result will hold the same. And that's for question number 1. And we will go through the second and third question real quick, because a lot of information I mentioned earlier has already built a foundation for our questions. The second question is about the credit risk of Amazon. Just take a look at the numbers which are related to credit risk. Number 1, the consecutive years of negative cash flow. Just imagine that as the competitors arise and they give you threat that you should deliver goods more quickly to the hand of the customers. And at the same time, You should make sure all the process logistics won't go wrong. And what does it take to make sure this timeliness and accuracy? It's IT controlling and distribution centers. So put Amazon in that situation as we just went through. They gotta invest more on the fixed asset, and which means they are making their financial flexibility less. And the second, worse operating conditions. Like I just mentioned before, the investment loss and increasing operating expenses just became a headache for them. The third one is the high debt-to-asset ratio, even up to 99%. And the fourth is the bad credit rating. All four indicators make us believe that there was definitely significant credit risk lying in Amazon. So we share the same outlook with the analyst's assessment. And the third question is why the market reacts so badly and fears. Those are the factors. First, the investors' doubt in operating capability of Amazon. Second, most of the investors are sensitive and irrational. They make buy and sell decisions mostly without knowing the whole picture. So we think this is the main reason why the market reaction was this big. And the third one, stock price and bond price are related. Bond price goes down is reasonable since there's credit risk and therefore everyone try to get rid of it. But what makes worse is that if the stock price also goes down, the bondholder won't be likely to convert its bond to stocks and therefore put the bondholders in an even harder situation. So that's our answer to the third question. And that's the end of our presentation. Thanks for watching and hope you like our presentation. If you have any question or comment, please leave it below. Thanks again.